Hey everyone, hope all is well. I want to do a quick financing comparison. I pulled up a spreadsheet that I want to share with you today so you can make the best decision on your next real estate deal. Okay, so there's a few different options when it comes to financing. So you can use a bank, you can use cash, you can use a joint venture partner, you can use a hard money lender. And as you can see up here, there's a difference. Obviously, a bank, for instance, cheap. Banks are inexpensive. They have cheaper capital. But there's a lot more strings attached, and potentially you might even need more cash out of pocket to use a bank. Cash, obviously, if you can use cash, you'll see, and we're going to go through this, that your net profit on a deal will obviously be the highest, but you need to have the cash to do the project. Joint ventures typically. A lot of people are attracted to joint ventures. Someone puts up all the cash, the other person does all the work. The problem with that is typically the net profit is the least amount. And then you have hard money lenders, which typically has the most flexible terms. Yes, they end up being a little bit more expensive, but you obviously don't need as much cash in a hard money loan compared to a bank, and your net profit ends up being typically biggest bang for your buck. And if you look on your cash on cash return, that's typically the best in this case. So let's just go through this real quick. This is assuming you have a $100,000 purchase price and a $300,000 construction holdback, and it's worth $200,000, a $200,000 exit. So a lot of these things are the same. The purchase price, the construction costs, all the same. Your closing costs are going to be around $5,000 no matter what you do, if you pay cash or you get money for it. Holding costs the same as well. Utilities, utility bills, other kind of like miscellaneous maintenance, like maybe mowing the grass, stuff like that. And then we're all selling at $200,000, and your resale costs are all the same, assuming like realtor fees, transfer and recordation tax, or transfer tax on the resale. So that's all the same as well. So here's a few things that come into play a lot. Okay, so let's just use the two that you're financing. Let's go through that first. So if you use the bank, obviously your financing points are less than a hard money lender, right? Your costs in general are going to be a little bit less. Your purchase, total financing costs are going to be less, obviously. But the big thing to look at is the total cash needed for the life of the deal. Typically with a bank, they're going off a loan to cost, or you're going to need just more cash in the deal. So in this case, you need $43,000 into the deal. And with a hard money lender, you need about half of that into the deal. So there's pros and cons. If you have the available cash, it might make sense doing it. And if you have the time, it might be worth doing it. But in this case, if you look, your total cash needed for this deal is only $21,000, and that includes payments. So typically your cash to close is going to, with a hard money lender, is going to be $10,000 in this case. And then total with payments over a 6-month term is $21,000. So that's not bad. You get a $130,000 loan for somebody. You only need $10,000 into the deal up front, and with payments, you're putting out $21,000. And in that case, you're getting a return. Your net profit is $35,000. So that's good. And on the other side, the bank, in this case, you're making a lot of profits using other people's money. But keep in mind, with the bank, you're putting up about $40-something thousand just to get a $40,000 return. So you're getting about 100% cash on cash return, which is great. Don't get me wrong, but you do need more cash into that. This is the misleading one a lot. A lot of people come to me and say, hey, I want to use a joint venture partner. They put up all the money and I do all the work. Well, that's great. But like eventually you got to grow out of that. And the reason why is that's great. Let them put up the money. But like they're getting the best deal, right? They're getting the best deal on this thing. You're only making $24,000 on this, right? You're only making $24,000, and you're doing all the heavy lifting, right? So look, compared to the joint venture partner versus doing a loan with a hard money lender. Doing a loan with a hard money lender, you're making almost $12,000 more on the deal, and you only need to put in, 10,000 up front, 20,000 total. So again, the purpose of this financing comparison is you make the decision where it works best for you. Do you want to go to a bank, make some of the best profits, but also put in a lot of money and you have the kind of the red tape on it? Do you want to use all cash? Most people don't have that ability. If you do, sure, go for it. Just remember there's opportunity costs with cash. Do you want to use a joint venture partner where you really don't need to put much into the deal, but you're also not going to make a ton of money on the deal? Or do you want to use a hard money lender where it's kind of a mix of all of it? You got to put a little bit of money in, but you also make a good return type of thing. So if you need anything, reach out to Jason at hardmoneybankers.com, and happy to quote your next loan for you and see what we can do. We're aggressively lending in Maryland, Virginia, DC, Delaware, New Jersey, and Pennsylvania. We can do 1 year fix and flip loans, or we can do 5 year amortized loans. Hope all is well. Take care.